Welcome to the Deep Dive. Today we're taking a deep plunge into a topic that's, well, it's been electrifying boardrooms and tech labs pretty much everywhere. We've got a stack of fresh reports and an earnings call transcript from a company right at the very heart of the AI revolution, NVIDIA. Okay, let's unpack this.
Absolutely. Our mission today is really to sift through NVIDIA's second quarter fiscal 2026 results. They just came out August 27th, 2025. We'll pull out the key financial highlights, try to understand the innovation that's driving this, frankly, unprecedented growth, and then explore the future opportunities, but also the challenges, especially in really key and complex markets like China. We're here to give you the insights that really matter.
Yeah, and this isn't just about the numbers, right? It's about understanding the foundational tech that's shaping our future. Everything from cloud computing to, well, robotics, and what it means for you, whether you're maybe an investor, a developer, or maybe just someone really curious about where AI is actually headed. We'll try to break down the jargon, give you the essential insights you need. Hopefully you'll feel well informed, maybe even a bit ahead of the curve.
Indeed. We'll be looking at how NVIDIA is navigating this really dynamic external environment. Geopolitical factors are always there, right? And at the same time, they're forecasting this massive industrial revolution driven by AI. It's quite a claim. We'll also touch on some of the debates, around the sustainability of this rapid growth and the incredibly high expectations the market has for them. It's a fascinating tightrope walk.
Okay, let's click things off with the headline numbers. NVIDIA's Q2 fiscal 2026, they just delivered another record-breaking quarter. These figures are quite something. Total revenue clocked in at $46.7 billion. So the quarter ending in July, now this wasn't just a record, it actually beat their own outlook and what analysts were expecting, which was kind of hovering around $46.2 billion. And that represents a staggering 56% growth compared to the same quarter just a year earlier. That indicates some seriously robust expansion.
It's a profoundly significant figure. And if we connect this to the bigger picture, it points to really strong sequential growth across all their market platforms, which is critical. But more broadly, it's really telling for the health of the entire AI industry, which, as we've seen, is now acting as a key engine for market gains and, frankly, overall economic growth globally. You have to think about the ripple effect, right? Companies adopt AI, they invest in infrastructure and software services. It creates this virtuous cycle that's driving substantial economic activity. But it's also important to look at the details. Their data center segment, which, let's be clear, is the core engine of NVIDIA's growth now, accounts for about 89% of their total sales. That segment saw revenue climb an impressive 56% year over year. What's maybe even more impressive is that it grew sequentially, even with a notable $4 billion decline in H20 revenue during the quarter. And just to clarify for listeners, the H20 chip, that's NVIDIA's specialized GPU designed to comply with U.S. export restrictions for the Chinese market. So that decline in sales in Q2 was a direct result of those external factors, the review of export licenses, which we'll definitely get into more detail on later. Yet, despite this really impressive growth and despite overall revenue beating expectations, the data center revenue specifically came in at $41.1 billion. That was slightly below the analysts' very high expectations for $41.3 billion.
So a narrow miss, as it was called. Given how absolutely crucial that data center segment is for NVIDIA's whole strategy, their valuation, does this slight miss suggest any, underlying vulnerabilities? Or is it just proof of how stratospheric market expectations have become for a company that seems to constantly deliver?
It's a great question, and it really highlights the unique spot NVIDIA is in right now. This narrow miss actually caused a slight dip in NVIDIA's shares in after-hours trading, maybe around 3%. Now, that reaction, for missing by just $200 million on a $41 billion segment, it really underscores that NVIDIA is, priced for perfection. That's the term being used. It means investors aren't just factoring in strong growth, they're factoring in exceptional growth. There's very little room for even minor deviations. Any deviation, no matter how small, can trigger a sort of knee-jerk reaction, puts immense pressure on the company, obviously. But it also reflects the market's profound confidence in their long-term potential. And on the net income side, quarterly net income was also incredibly robust. $26.4 billion. That's 59% higher than a year earlier. And that actually surpassed Wall Street's projection, which was $24.7 billion. So, look, while there was a slight segment miss against what you can only call superhuman expectations, the overall financial health, the profitability, undeniably strong.
Yeah, that context really helps frame the market's reaction. So even with that incredibly high bar, the numbers are still just phenomenal. It sounds like demand for their core AI chips is, through the roof. And it's not just data centers driving this. Their gaming segment, which is where many of us first heard of NVIDIA, hit a record $4.3 billion. That's a healthy 14% sequential increase and a massive 49% jump year on year. Apparently, this was largely driven by the successful ramp of their Blackwell GeForce GPUs, it's the latest generation for consumers, and just increased supply availability, including the new GeForce RTX 5060 desktop GPU. Now, for gamers listening, the RTX 5060, they're saying it brings double the performance of previous generations. Advanced ray tracing for super realistic lighting, neural rendering, and AI-powered DLSS4 gameplay. DLSS, that's deep learning super sampling. It's NVIDIA's AI upscaling tech that boosts frame rates and image quality at the same time. It really is a game changer. And here's a cool detail. Blackwell is also coming to GeForce. Now, that's their cloud gaming service in September.
They're promising RTX 5080 class performance with minimal latency, 5K resolution at 120 frames per second, and they're even doubling the GeForce Now catalog to over 4,500 titles. Huge library. Beyond gaming, their professional visualization revenue hit $601 million, up 32% year-on-year. That's thanks to high-end RTX workstation GPUs and AI-powered workflows like design, simulation, prototyping. We're seeing key customers using these. Like Activision Blizzard uses RTX workstations for creative stuff, and robotics innovator Figure AI powers its humanoid robots with RTX embedded GPUs. And the automotive segment also saw big growth, up 69% year-on-year to $586 million, primarily from demand for self-driving solutions and the first shipment of the NVIDIA Thor system on chip, or SoC. Thor, they say, delivers an order of magnitude greater AI performance and energy efficiency, which is vital for that industry's shift towards vision language models and higher levels of autonomy in cars.
Right. Beyond the impressive numbers, if we dig deeper into what's truly powering this engine, we get to NVIDIA's continuous, aggressive innovation with its core platforms, especially Blackwell and its successors. These are really fueling what they're calling the AI industrial revolution. The Blackwell platform itself hit record levels, growing sequentially by a strong 17%. And the actual production shipments of the GB300, a key Blackwell component, began in Q2. What's really noteworthy here is that the transition for the major cloud service providers, the CSPs, has been described as seamless. That's largely because Blackwell shares architecture and software with the previous GB200. So these providers can build and deploy GB300 racks pretty easily, minimizing downtime, integration headaches, huge deal for them. And looking at production availability, current production for the GB300 is apparently back at full speed. They're churning out approximately 1,000 racks per week, with expectations to accelerate even further in Q3 as more capacity comes online. So this means we can expect widespread market availability in the second half of the year. Companies like CoreWeave are already getting ready to bring their GB300 instances to market, and the early reports are pretty astounding. CoreWeave is reportedly seeing a 10x inference performance on reasoning models compared to the previous H100 generation. Now, this generational leap isn't just about speed. It's about enabling entirely new types of AI applications, new business models that just weren't feasible before because of performance or cost. Imagine, real-time complex decision-making, sophisticated scientific simulations, highly personalized AI experiences, all brought closer to reality by this kind of power.
Yeah, here's where it gets really interesting for me. This talk of 10x performance and seamless transitions, it highlights NVIDIA's incredible pace, just relentless innovation. But what does this actually mean for the companies using these chips? And ultimately, what does it mean for you, the end user of AI? Because 10x is a huge jump, right? But how does that translate into, real benefits? Well, a big part of it seems to be energy efficiency and, crucially, revenue generation. The GB300 NVL72 AI factories, they promise a 10x improvement in token per watt energy efficiency compared to the Hopper generation. This is absolutely critical because data centers, by their very nature, are often power limited. They face constraints not just from the grid, but cooling capacity, even physical space. As NVIDIA's CEO Jensen Huang puts it, their performance per watt, drives directly to revenues for their customers. And he gave this tangible example. A $3 million investment in GB200 infrastructure can apparently generate $30 million in token revenue for their customers. That's an incredible 10x return. So it's not just about faster chips.
It's about making AI deployments dramatically more economically viable, more scalable. And it's not just the hardware either. NVIDIA's performance leadership is heavily underpinned by their software innovation, plus the strength of their developer ecosystem. They've actually improved Blackwell's performance by more than 2x just since its launch, through advances in their CUD platform, that's their parallel computing platform and programming model, along with Tensor RTLM and Dynamo. These are continuously unlocking maximum efficiency from the hardware. It's no surprise NVIDIA is a top contributor to OpenAI models, data, and software. It shows that integrated approach. Furthermore, Blackwell has introduced what they call a groundbreaking numerical approach for large language model pre-training. Using something called NVFP4 computations on the GB300 can achieve 7x faster training than the H100, which uses FP8. Now, for those not familiar, FP4, FP8, FP16, they refer to different numerical precisions for calculations. Usually lower precision like FP4 is faster but can be less accurate. The big innovation here is that Blackwell delivers the accuracy of 16-bit precision, but with the speed and efficiency of 4-bit. That sets a new standard for AI factory efficiency and scalability. This is a massive leap in how quickly and affordably large AI models can be trained, which in turn accelerates the development of more sophisticated AI applications. And the big players are already jumping on this: AWS, Google Cloud, Microsoft Azure, OpenAI, alongside others like Coher, MRL, Kimi AI, Perplexity Reflection, Runway. Their performance leadership was also validated again in the latest MLPerf training benchmarks. The GB200 apparently delivered a clean sweep across all categories.
Right, and building on this relentless pace, this annual product cadence, that's clearly a core strategy for NVIDIA. We're already seeing them on track for volume production of the Rubin platform next year. Rubin will be their third-generation NVLink rack-scale AI supercomputer, built with components like the Vera CPU, Rubin GPU, CX9 SuperNIC, and Spectrum-X. The chips for Rubin are apparently already in fabrication. They're maintaining that aggressive annual cycle to accelerate cost reduction, maximize revenue generation for customers by constantly increasing that perf per watt, which, again, is just critical in a power-limited data center world. Every watt, every dollar of CapEx has to translate into maximum computational output. And what's particularly fueling this long-term demand and kind of influencing NVIDIA's design choices is the emergence of what they call reasoning agentic AI. This isn't just chatbots giving simple one-shot answers anymore. These new AI systems can do sophisticated research, they can think critically, plan multi-step processes, and they can actually use tools like web browsers or enterprise software like SAP or ServiceNow to perform complex tasks autonomously. This long thinking process, as Jensen Huang called it, needs 100 to 1,000 times more computation than previous models, potentially even more as the AI's research and comprehension capabilities grow. So this dramatic increase in computational need is directly driving demand for NVIDIA's high-performance platforms, like the Blackwell NVLink 72 system, which was explicitly designed for this moment. It's capable of disaggregating into a rack-scale computer, meaning it can function as one massive unified system, allowing for unprecedented memory sharing collaboration between GPUs, which is absolutely essential for these really complex multi-stage reasoning tasks.
It's interesting. While the GPUs get so much of the spotlight, and rightly so, given the performance, NVIDIA is clearly building out a much broader full-stack solution. It feels like they're not just providing the brain, but also the nervous system, and increasingly maybe even the physical body for these AI entities. Let's talk about networking and robotics, two areas showing incredible growth and strategic importance that go way beyond just the core processing units.
Indeed. NVIDIA isn't just a chip company anymore. They explicitly call themselves an AI infrastructure company, which means they're developing the entire ecosystem around these massive AI factories. The networking segment, for instance, delivered record revenue of $7.3 billion. That's a remarkable 46% sequential and a massive 98% year-on-year increase, just huge growth. And this explosive demand is fueled by the absolute necessity for high-efficiency, low-latency networking in these increasingly complex, vast AI compute clusters. Unlike traditional data centers that might move big files occasionally, AI clusters are constantly shuttling massive data sets between thousands of GPUs. They need incredibly fast, synchronized communication to avoid bottlenecks. So NVIDIA now offers 3 distinct networking platforms, each designed for a specific purpose in scaling AI. First, there's NVLink for scale-up. This is designed for building the largest possible virtual GPU. NVLink 72, as part of Blackwell, allows a full rack of 72 GPUs to act as one unified supercomputer, with an incredible 14 times the bandwidth of PCIe Gen 5. Now, to put that in perspective, PCIe Gen 5 is the standard way components inside a computer talk to each other. So 14 times that speed for inter-GPU communication. It's revolutionary, especially for agentic AI, as it massively amplifies memory bandwidth, critical for training and running the largest, most complex models that need to access huge amounts of memory simultaneously. We even see it being adopted in advanced projects like Japan's upcoming Fugaku Next supercomputer, which will integrate Fujitsu CPUs with NVIDIA's architecture via NVLink Fusion for really demanding workloads, AI supercomputing, quantum simulations. Second, we have InfiniBand and Spectrum-X Ethernet for scale-out. InfiniBand remains the choice for supercomputing leading model builders. It nearly doubled revenue sequentially with XDR technology, which doubles the bandwidth over its predecessor. But for those preferring Ethernet, Spectrum-X Enhanced Ethernet provides high throughput, low latency, and it's specifically designed for AI workloads, not just off-the-shelf Ethernet. That distinction is really crucial because AI workloads have unique traffic patterns, demands that standard Ethernet just isn't optimized for. Spectrum X is a significant part of their business now, annualized revenue exceeding $10 billion and growing double digits. And third, a newer innovation, Spectrum XGS Ethernet for scale across. This new tech is designed to unify multiple AI factories into what they call gigascale AI superfactories, connecting multiple data centers seamlessly. CoreWeave is an initial adopter, and they're projecting it will double GPU to GPU communication speed across different locations. Look, the strategic importance of choosing the right networking solution here, it really cannot be overstated. Improving factory efficiency by just, say, tens of percents can translate to billions in effective benefit for a multi-billion-dollar AI factory. This is precisely why NVIDIA bought Mellanox, the high-performance networking leader, years ago, and why networking has become such a very big part of their business. It directly impacts the performance per watt and therefore the revenue generation of the entire AI factory. It ensures that the incredible power of their GPUs isn't choked by slow data movement.
Wow, it really sounds like they're building the nervous system for these AI brains, letting them communicate and coordinate on a scale we've never seen before. That's a huge undertaking. But what about the physical embodiment of AI robotics? It feels like that's the next frontier where AI goes from the cloud into the real world, turning intelligence into actual action.
Absolutely. The age of physical AI, robotics, it feels like it's upon us. And NVIDIA is making significant strides here too. Their new robotics computing platform, Jetson Thor, is now available. Thor delivers, they say, an order of magnitude greater AI performance and energy efficiency than its predecessor, NVIDIA AGX-R. This enables really state-of-the-art robotics, running the latest generative and reasoning AI models right at the edge, meaning directly on the robot itself in real time. That level of on-device intelligence is critical for autonomous operation in, unpredictable real-world environments. And the adoption of NVIDIA's robotics full-stack platform is growing rapidly. Over 2 million developers now, 1,000 plus hardware, software, sensor partners taking their platform to market. We're seeing leading enterprises across all sorts of industries adopting Thor. Big names like Agility Robotics, known for its humanoid robots, Amazon Robotics for logistics, Boston Dynamics, obviously, for advanced mobile robots, also Caterpillar for heavy machinery automation, Figure for general-purpose humanoid robots, Hexagon for industrial measurement, Medtronic for medical devices, and even Meta for advanced research. Robotic applications, just by their nature, require exponentially more compute, both on the device and in the supporting infrastructure. So that represents a significant long-term demand driver for their data center platform too. And for development, they have NVIDIA Omniverse with Cosmos. That acts as their data center physical AI digital twin platform, built specifically for developing robot and robotic systems. Think of a digital twin like a virtual replica of a physical robot or a factory. It lets engineers simulate, test, optimize robotic systems in a safe virtual environment before deploying them in the real world. Hugely accelerates development, reduces costs. This quarter, they announced a major expansion of their partnership with Siemens to enable AI automatic factories. With leading European robotics companies like Agile Robots, Neuralocidics, Universal Robots, all building their latest innovations with the Omniverse platform. NVIDIA really envisions a future where, quote, everything that moves will be robotic, from cars and tractors to escalators and humanoid robots. Jensen Huang articulated this fascinating perspective. Every industrial company will eventually need two factories. One to build the machines themselves, and another to build and refine their robotic AI. That represents a monumental shift in industrial automation, an entirely new industry unlocking right before our eyes, with AI becoming the animating force for physical systems. Okay, turning our attention now to the global stage, we absolutely have to address one of the most significant and frankly complex challenges NVIDIA faces, especially given its global ambitions. That's the China market and the geopolitical headwinds that come with it. This creates a really fascinating dance between immense market opportunity and tightening regulatory constraints. In late July, the U.S. government began reviewing licenses for sales of their H20 chips to China. Now, while a select number of China-based customers have received licenses over the past few weeks, NVIDIA confirmed they have not yet shipped any H20 based on those approvals. U.S. government officials have apparently expressed an expectation of receiving 15% of the revenue generated from licensed H20 sales. But it's really important to note a formal regulation codifying that hasn't been published yet. So that legal ambiguity just adds another layer of complexity, uncertainty to an already very fluid situation. And as a direct result of these geopolitical issues and the lingering uncertainty, NVIDIA explicitly did not include any H20 shipments to China in its Q3 outlook. That decision alone really highlights the significant financial impact of these policies. However, CFO Colette Kress did note that if these issues resolve, they could ship between $2 billion and $5 billion in H20 revenue just in Q3. and potentially more if new orders came in. So it's a dynamic situation, potentially very lucrative if the regulatory environment clarifies. Looking at past sales, in Q2, NVIDIA did manage to sell $180 million of previously reserved H20 inventory into China, and about $650 million of H20 to an unrestricted customer outside of China. Earlier in the year, the company had even warned of an $8 billion potential hit to revenue due to the initial restrictions on China chip exports. Just underscores the sheer scale of this market, the revenue at stake.
So what does this all mean? It's clearly very fluid, represents both a massive opportunity and, well, significant uncertainty for NVIDIA. On one hand, China is this staggeringly large market, but on the other, it's shrouded in these geopolitical complexities that could limit access. Jensen Huang himself estimates the China market could be a $50 billion of opportunity for NVIDIA this year if they were able to address it with competitive products. And he expects it to grow about 50% per year, mirroring the growth seen in the rest of the world's AI market. He highlights, look, China is the second largest computing market in the world, home to about 50% of the world's AI researchers. It's an undeniable force in the global AI landscape, both as a customer and as a contributor. Now, NVIDIA is actively advocating for U.S. government approval to sell its advanced Blackwell chips to China, potentially a modified version, right? With reduced capabilities, as President Trump had suggested, maybe a 30–50% reduction to beat export controls. Huang sees this as a real possibility, and he's not alone. Some analysts think there'd be massive demand for a chip like that, even if modified. But is there a risk here that by advocating so strongly for access to China, NVIDIA might be, I don't know, inadvertently helping to accelerate China's own chip development, potentially creating a more formidable long-term competitor down the line?
That's the critical strategic tension, isn't it? And it's one that policymakers and companies like NVIDIA are really grappling with. Huang champions what he calls the American tech stack argument. He firmly believes it's vital for American companies to be able to address the Chinese market. He argues it benefits the U.S. economy, U.S. leadership in competitive markets, and it helps make the American AI technology stack the world standard. Think of it like, I don't know, Android versus iOS. Maintaining market share and influence in key regions helps solidify your platform as the global default. He points out that China creates the vast majority of the leading open source models, like DeepSeek, Q1, Kimi, Moonshots, Seed. These are used globally. If U.S. companies are completely cut off, not only do they lose a massive revenue stream, but they also risk losing influence over the direction, the adoption of global AI standards, potentially ceding that ground to non-U.S. alternatives. This complex interplay of market opportunity, geopolitical strategy, it inevitably leads us to another critical piece, the burgeoning local competition within China itself. How is China responding to these restrictions? Are its domestic players truly a threat? Well, Chinese semiconductor firm Cambricon reported a record profit and a more than 4,000% surge in revenue in the first half of the year, reaching $402.7 million in revenue, $1.04 billion in net profit. Now, okay, these numbers are still small compared to NVIDIA's multi-billion-dollar figures, but they powerfully underscore how local challengers are gaining traction as Beijing actively pushes its domestic industry to develop alternatives to American tech. And this push is significant. Reports suggest Beijing has actually been discouraging local firms from buying NVIDIA's H20 chips, even after the U.S. government lifted the ban. Combine that with U.S. export controls that effectively block China from accessing the most advanced chip-making techniques, it creates a very complex, very challenging landscape for NVIDIA. Jensen Huang acknowledges that Chinese companies are very competitive with extraordinary skills and capabilities. He cautions against underestimating them, especially in manufacturing and their ability to innovate quickly when faced with external pressure. So NVIDIA's view on China's importance remains clear. Huang considers China not just nice to have, but important for every American technology company. Because of its dynamic, innovative, fast-growing market and its substantial contribution to open-source AI models used worldwide, the underlying ecosystem, the demand in China, it's robust. But the political and competitive layers add undeniable friction and uncertainty, forcing NVIDIA to navigate a very, very delicate balance.
Okay, looking beyond the current quarter now, what's the long-term vision from NVIDIA? Jensen Huang talks about an industrial revolution, these staggering market opportunities projecting trillions in spending. But at the same time, we've also heard some pretty prominent voices warning of an AI bubble, kind of reminiscent of the dot-com era. So what does this all mean? Is this unprecedented growth sustainable, or are we maybe heading for some kind of correction?
Yeah, this brings us to a crucial, maybe the overarching question for the industry and for anyone watching this space. Is the AI boom sustainable, Or are we heading for a correction? There are clearly two differing, sometimes contrasting perspectives here, and it's important to consider both. Jensen Huang, for his part, projects that AI infrastructure spending will reach a colossal $3 to $4 trillion by the end of the decade. He suggests NVIDIA could capture as much as 70% of that revenue, painting this picture of immense, almost unimaginable opportunity. He emphasizes that the CapEx, the capital expenditure of just the top 4 hyperscalers, think AWS, Microsoft Azure, Google Cloud, Oracle, has doubled in 2 years to $600 billion annually. And this, he argues, is just the beginning of a massive global build-out. This isn't just about cloud providers either. It's about every industry recognizing the need for AI. Think manufacturing building AI-driven robotic factories, healthcare using AI for drug discovery, diagnostics, financial institutions leveraging AI for advanced analytics, fraud detection. Each of these sectors contributes to this projected spending, creating entirely new services, new products that redefine their industries. Colette Kress, NVIDIA's CFO, she outlines several key factors fueling this projected long-term growth for the decade. Helps us understand the drivers beyond just the current demand spike. Firstly, there's the rapid evolution of reasoning agentic AI, which, as we discussed, requires orders of magnitude more training and inference compute as AI systems get more complex, capable of thinking, planning, using tools. This isn't a marginal increase, it's exponential. Secondly, we're seeing global build-outs for sovereign AI. Nations around the world developing their own AI infrastructure using domestic resources, data, talent. This isn't just about economic competitiveness. It's also about national security, data sovereignty, ensuring critical AI capabilities are controlled domestically. For example, Europe planning $20 billion for 20 AI factories, including 5 gigafactories. The UK launching its Isambard AI supercomputer. NVIDIA expects over $20 billion in sovereign AI revenue this year alone, more than doubling last year's figures, shows a powerful trend driven by national strategic imperatives. Thirdly, enterprise AI adoption is accelerating. Companies modernizing their data centers with solutions like RTX Pro servers, poised to be a multi-billion-dollar product line, integrating easily into standard IT environments. Companies like Hitachi, Lilly, Hyundai, Disney already adopting these. And finally, the arrival of physical AI and robotics is unlocking entirely new industries, moving AI from the digital realm into the physical world, as we talked about with Justin Thor and Omniverse. So NVIDIA's strategy, supported by that annual product cadence Blackwell now, Rubin next year, it's designed to accelerate cost reduction, maximize revenue for customers by continuously increasing perf per watt, which is critical in that power-limited data center world. This constant innovation is what they believe will sustain their growth, ensure their products remain indispensable for these monumental AI build-outs.
That vision sounds incredibly ambitious, suggests exponential growth for years to come. But let's address the elephant in the room. Are we in an AI bubble right now? It's a question on a lot of people's minds, given the rapid rise of these companies, their valuations. Jensen Huang's projections are undeniably bold, but are there any historical parallels where such massive market expansions didn't quite materialize? Or maybe faced unforeseen headwinds that could temper these expectations?
Yeah, the AI bubble debate is definitely heating up, and it's essential to look at both sides. History shows us periods of intense tech excitement can lead to overvaluation. But there are also maybe some fundamental differences in the current AI boom. On the concern side, you have prominent figures like Torsten Slick, chief economist at Apollo. He suggested the AI bubble could actually exceed the dot-com bubble of the 90s, implying the top firms are significantly overvalued relative to current earnings or underlying economic output. Even OpenAI CEO Sam Altman, a central figure here, admitted, quote, "Are we in a phase where investors as a whole are overexcited about AI? My opinion is yes."
Whoa.
He also acknowledged MIT researchers found most companies aren't actually making money yet from implementing AI, which raises questions about real-world profitability, the immediate ROI for many adopting businesses. That could eventually temper demand for infrastructure if the applications don't materialize fast enough. However, NVIDIA's Jensen Huang, while acknowledging the buzz, the rapid market excitement, he sees a different picture. He points to several fundamental factors to counter the bubble narrative. First, the incredible growth of companies like OpenAI, reaching $1 billion a month in revenue now, demonstrates real commercialization, a viable business model for AI services. It's not just speculation, it's actual revenue. Second, the rapid expansion of AI-native startups, collectively generating $20 billion in revenue this year. That's a tenfold increase from $2 billion just last year. Shows a vibrant ecosystem of new businesses emerging, finding market fit, driving genuine demand for the underlying infrastructure. Third, the widespread adoption of AI across pretty much all industries: clouds, enterprise, industrial, robotics, self-driving cars, digital biology, drug discovery. He highlights that H100s and H200s, their previous generation high-end GPUs, are sold out. Large cloud service providers are scrambling to get capacity. This indicates very real, tangible demand driven by operational necessity, not just speculative investment. And despite the bubble concerns, it's worth noting the AI sector remains a bright spot for the economy. It added a 0.5 percentage point boost to annualized U.S. GDP growth in the first half of 2025, according to Pantheon Macroeconomics. So that suggests even if some valuations are stretched, there is a fundamental economic impact, real productivity gains happening. Ultimately, this leaves us with an important question for you, the listener. Is this an opportunity, a bubble, or maybe some complex combination of both? What seems clear is that the fundamental technology is truly transformative regardless of market valuations, and its integration into the global economy is really just beginning.
Okay, let's quickly drill down into some other important financial metrics from the quarter, and then look at what NVIDIA is projecting for the next quarter, Q3. These details help fill out the complete financial picture, give us some insight into their operational health.
Yeah, we continue to see a pretty impressive operational efficiency and strategic capital allocation at NVIDIA. Looking at gross margins, NVIDIA reported a GAAP gross margin of 72.4% and a non-GAAP gross margin of 72.7%. Now, these figures include a $180 million benefit, about 40 basis points, from releasing that previously reserved H20 inventory. But even excluding that one-time benefit, non-GAAP gross margins would have been 72.3%, still comfortably beating their own outlook. These high margins, they're not just good numbers. They reflect NVIDIA's incredible pricing power, stemming from their unique IP, their integrated software-hardware ecosystem, and the critical, almost irreplaceable nature of their solutions right now. This robust profitability lets them reinvest heavily into R&D future growth while maintaining strong financial health. They expect to exit the year with non-GAAP gross margins comfortably in the mid-70s, reflects continued strong pricing power and cost management. For Q3, they're forecasting GAAP and non-GAAP gross margins of 73.3% and 73.5% respectively, plus or minus 50 basis points. Operating expenses are also seeing increased investment. GAAP operating expenses rose 8%, non-GAAP rose 6% sequentially. This increase was driven by higher compute and infrastructure costs, also higher compensation and benefit costs to support that aggressive ramp of Blackwell and Blackwell Ultra platforms. The increase in OpEx, particularly for compute and infrastructure, it directly points to NVIDIA's aggressive scaling strategies. They're pouring resources into building out their own internal AI capabilities and infrastructure, not just for R&D on next-gen stuff like Rubin, but also to facilitate the massive production ramp-up needed to meet this surging global demand. It's not just hiring more engineers, it's fundamentally building out the foundation for future growth at an accelerated pace. For the full year, they now expect operating expenses to grow in the high 30s range year over year. That's up from prior expectations of the mid-30s. This acceleration of investments just underscores their commitment to addressing the magnitude of the growth opportunities they see ahead. And finally, on inventory. Inventory increased sequentially from $11 billion to $15 billion in Q2. Reflects that necessary buildup to meet surging demand for the new platforms, ensure robust supply chain readiness, mitigate against potential future disruptions.
And what about returning value to shareholders? That's always a key question for investors, right? Especially with a company growing at this pace, generating such significant profits.
Indeed. While they're prioritizing funding for their significant growth and strategic initiatives, NVIDIA also actively returned capital to shareholders. In Q2, they returned a substantial $10 billion to shareholders through a combination of share repurchases and cash dividends, and further signaling strong confidence in their future prospects, the sustainability of their business. Their board just approved a new $60 billion share repurchase authorization. That adds to the remaining $14.7 billion authorization from the end of Q2. Highlights a robust commitment to shareholder returns and a belief that their stock remained a strong investment. Turning to their outlook for Q3, NVIDIA projects total revenue to be $54 billion, plus or minus 2%. That represents over $7 billion in impressive sequential growth, demonstrates continued momentum. Importantly, this Q3 guidance does not assume any H20 shipments to China customers, which highlights that continued geopolitical uncertainty we talked about. If those issues resolve, the guidance could actually prove conservative, leaves room for further upside. Jensen Huang reiterated strong long-term confidence, stating, "This year is obviously a record-breaking year. I expect next year to be a record-breaking year as well." That's a pretty bold statement. Underlines the immense long-term growth opportunities they foresee as this AI industrial revolution continues to unfold.
So what does this all mean? We've seen NVIDIA deliver another really powerful quarter, demonstrating the extraordinary, almost insatiable demand for their AI infrastructure. From the seamless ramp of Blackwell to the explosive growth in networking, the visionary push into robotics and physical AI, they are truly at the forefront of what they're calling an industrial revolution. They're not just selling chips anymore, they're selling the entire factory that manufactures intelligence, offering this full-stack solution, hardware, software, networking, the whole package.
Precisely. If we connect this to the bigger picture, we've navigated the complex geopolitical landscape of the China market, where a potential $50 billion opportunity kind of hangs in the balance due to licensing, policy uncertainties. We've also discussed the contrasting views on the AI market potential bubble for some, but an unprecedented, sustained growth phase for others. Driven by real economic and technological shifts, NVIDIA's core strategy, relentless innovation, focusing on performance per watt to drive customer revenue, that comprehensive full-stack approach, it's clearly resonating in a world that's just hungry for AI.
Yeah, this deep dive really reveals a company not just riding some massive technological wave, but actively creating it, shaping its direction. The scale and scope of these AI build-outs are just immense, and the impact is going to be felt across every single industry, touching nearly every aspect of our lives.
And for you, the listener, whether you're building businesses, making investment decisions, or maybe you're just curious about the world around you, understanding these dynamics is paramount. We are truly at the beginning of an era where, as Jensen Huang suggests, every job will be changed as a result of AI. It isn't just about efficiency. It's about fundamental transformation of how we work, how we live, how we create.
And that's definitely a thought to chew on. How will your job change? How will your industry transform? What new opportunities will emerge? And what existing structures might be challenged? The future, powered by AI, is unfolding faster than ever. And understanding players like NVIDIA really gives you a front row seat to that revolution.